our today's session. Today, I would want us to look at chapter number 2 of management accounting. So management accounting, chapter number 2. Management accounting, chapter 2, which is cost classification. Cost classification. Remember that you're getting these live online classes from RCM College. Should you be wanting our videos or our simplified notes, simply get in touch with us by calling us through this number 0719 525,000. Now here we are, cost classification. Now it will be worthwhile for you to appreciate why you as a management accountant should be at a position of classifying your costs nicely. Remember the functions of a management accountant. There are many, could be about 10. The most important function of the management accountant, ladies and gentlemen, is what we call cost ascertainment. Cost what here? Ascertainment. There are so many organizations that are producing great things outside here, great goods outside here, but they have not costed them properly. So you get them, find they are selling, but at the end of the day, whatever sales proceeds they are getting is not able to sustain them simply because they are always at a loss. Why? Because costs were supposed to be up there, which would have enabled them, if they were able to calculate them properly, they should have been able to set a higher price. But because of wrong cost ascertainment, here they are. Fine, they're selling, but making what? Losses. And for you to be able to ascertain, peg on proper cost to your product, ladies and gentlemen, at the end of the day, you as a management accountant must appreciate this concept of what here? Cost classification. You must know, how do we classify these costs? Which costs in this case, ladies and gentlemen, for example, are controllable? Which costs, ladies and gentlemen, do we have powers over? Which costs will be varying as the output varies? How do we handle the fixed costs, which basically are our shutdown costs? For us to be able to appreciate, I'll be able to share with you my notes, or rather our RCM's notes. And these RCM's notes, you've said if you want them, simply call us today at 0719 525,000. You should be able to get great notes. So cost classification. To classify, we are told here, is to arrange. So cost classification is the arrangement of cost items in a logical sequence having regard to their nature. Costs are classified, we are told, according to their cost objectives. Cost objective is the activity for which a separate measure of cost is desired. A separate measure of cost is desired. They include, for example, we could be having this particular great activity of valuation of our stocks. So that we'll be having costs classified in accordance to stock valuation. How do they relate to the costs? Costs for decision making, I would of course want, ladies and gentlemen, to cost products in a way that will be able to help us achieve this most important activity in an organization called decision making. Then you have got cost for what here? Control purposes. Very, very important. Ladies and gentlemen, I would want to reiterate something here. That a cost objective, a cost goal or cost objective is the activity, that activity which you would want to evaluate its cost as a standalone activity. A standalone activity. So we shall be able, ladies and gentlemen, to see further to this as we progress. So look at this. Cost objective, like the first goal will be to ladies and gentlemen, carry out a stock valuation. We have decision-making control purposes. So if you have a cost objective of stock valuation, if you have a cost objective of stock valuation, then what will be some of the classifications of costs under stock valuation shall we be having? Ladies and gentlemen, here we are told under stock valuation, we are going to have two types of costs here. We could have, for example, what we call manufacturing and a non-manufacturing cost. Ladies and gentlemen, listen and listen to me very well. Under stock valuation, we shall be having those costs. If you are to classify in terms of, if you are to classify them in terms of manufacturing and manufacturing, then we shall be having costs that can be pegged directly on the goods which were manufactured, What basically we shall be calling the direct costs, costs which are directly attributable to the products that we produce. And then we shall be having costs, which in this case here, which we shall be calling non-manufacturing. So non-manufacturing, these are costs that start right after we finish our production. So upon finishing production like this, all those activities that follow like distribution costs will be categorized, will be classified as non-manufacturing. I would want to repeat this classification, ladies and gentlemen. We are saying in terms of stock valuation, it will be very important for us to know which costs goes into our stock items directly. And those costs that are directly associated with our stocks are the ones we are calling what here? Manufacturing. Are the ones we are calling manufacturing. And then now we have the post-production costs. All of them should be lumped together to what we call non-manufacturing, non-manufacturing costs. Still under stock valuation, we could have a period and a product cost. We could have this kind of classification, yes. So periodical costs, ladies and gentlemen, are those costs, as the name period suggests, which are time-based. Like salaries, we pay our salaries on a monthly basis, like rent. We pay our rent on a monthly basis. So those two examples are great examples of periodic costs. They have got no association with the goods that we manufacture. If we manufacture a lot of items there, straight away, whatever stocks we'll be having is irrelevant as pertains to what here? Periodic cost, because whether we are producing or not, periodic cost must be incurred. And then, of course, you can see there, we have what we call the product costs. So now the product costs, these are the ones which are directly attributable to the products that we produce. So those ones must go to stock valuation. From there, ladies and gentlemen, we have direct and indirect cost. Of course, this is a simple classification. Direct costs, ladies and gentlemen, are those costs that are attributable to the products that you produce. Ladies and gentlemen, these are those costs that have got a positive relationship with the number of units here that we produce. Should we produce more, then the direct cost will be more. And then now we have the indirect costs. Indirect costs do not have any association with the number of units here that we do what here that we produce. No association at all. So, and as such, the indirect costs can never go to our stock valuation, simply because, ladies and gentlemen, indirect are general. They are not associated with the products that we produce directly. I hope you're together up to there. Now, ladies and gentlemen, listen here. Then we go to decision making. Decision making, ladies and gentlemen, basically we shall be looking at those costs that we can control. Costs in this case here that are futuristic. So we shall be having various buckets of classification. For example, under decision making, we shall be classifying the costs in accordance to cost behavior, and you can see the various buckets there. We shall be having variable costs, great classification. We shall be having fixed costs, which are quite irrelevant. in terms of decision making. Then we have relevance, and the relevance will be seeing, for example, opportunity costs are relevant. That's quite a great classification. We have sunk costs, which are historical, which are not irrelevant. We have standard costs, which will be calling what here? Normal costs. Ladies and gentlemen, this is just a high-level explanation. I'll be going to the nitty-gritties of these particular cost classifications, ladies and gentlemen, just within this lesson. Then we have a cost objective. Our cost is to control. If it is to control, then we shall be having our cost classifications being controllable, stroke non-controllable, and as we shall be seeing, controllable costs are those costs that are at the arm's length, which are at the arm's length. Those costs which are at the arm's length of management. So the management has got a say over them. The management must authorize, so they are in authority. They are able to influence controllable costs. And then, of course, as you shall be seeing later on, non-controllable costs, ladies and gentlemen, are those costs that management now have got no say whatsoever as regards to them. And of course, all fixed costs are what here? All fixed costs are non-controllable or uncontrollable. Now, ladies and gentlemen, here we are. In terms of controllability, we shall also be having some other classifications like avoidable. I can avoid this cost. Non-avoidable, etc. Now we look at these buckets of classification, where we shall start with the first one, which is the manufacturing cost. Ladies and gentlemen, if there is any topic that we should be able to understand very well as future management accountants, is this topic of cost classification. Once you understand which particular buckets will I be putting particular types of costs, then I'll be able to come up with models of cost estimation, which is our next chapter after this. So there is no way you'll be able to estimate your costs effectively, correctly, if you do not understand this concept of buckets, this concept of classifying, putting, arranging your various cost items into the various cost buckets. Into the various cost buckets. So, ladies and gentlemen, it will be very important for us to appreciate these things, these things, once and for all. Great. Because if you don't understand them, then automatically will not make a great management accountant. Now here we are. The first classification that I would want you to understand is the manufacturing cost classification. This is a very special bucket that we shall be putting all those costs that go into our production, all those costs that go into our production, all those costs that are attributable to manufacturing will be put in this bucket. Ladies and gentlemen, should we start really manufacturing, producing things? What will be some of the costs do we expect to lump under manufacturing? I can see them vividly. For example, we have the material, you have to procure raw materials. So material costs. And this material cost should be the direct material cost, direct, the ones in this case here which are attributable to production. So of course, once I bring in the materials, I must bring in workers who are coming to convert the materials into the finished goods. So the workers, of course, they have to be paid labor. So direct labor becomes part and parcel of manufacturing. And then we have these overheads. Overheads are common expenses. The common expenses that are directly attributable to manufacturing can also, will also be put here. But most importantly, what you're supposed to understand about manufacturing cost is this. What you're supposed to understand regarding so manufacturing cost, ladies and gentlemen, most importantly, You're supposed to understand here that these are costs incurred to produce a product. The element of manufacturing costs are direct materials, direct labor cost, and the overhead costs, which are directly attributable to production. The elements make up the total cost of a product are shown below, So they have explained them here. Material cost refers to all the physical inputs into a production process. Ladies and gentlemen, if for instance today I was a carpenter, of course a carpenter producing tables, some of the raw materials that I will need will be what here? We have, for instance, timber. So when I bring in the timber, that automatically will be accounted under raw materials. Raw materials, it's important for you to understand that. And then of course we'll have what we call labor. Of course we need labor, like some other carpenters will be assisting me, I'll be paying them salaries and wages. So if I'll be paying them on a per unit basis through what we call piece rate payment system. So I'll be able to say that I paid you 500 shillings for each table that you produced. Then that particular wage, which is directly attributable to the units we produce, will be called direct. So directly attributable to the tables, to the number of units here that you produce. Then automatically that will be classified under what here? Under manufacturing cost. Under manufacturing cost. So manufacturing cost, we're giving examples. We have direct materials, we have direct labor, and then, ladies and gentlemen, we have a particular concept of overhead here. They are also called, no, before this, I would want you to appreciate one thing, that when we talk of prime cost, primary cost, prime cost, we're looking at all the direct expenses. Prime cost, ladies and gentlemen, will be the direct expenses which are attributable to our manufacturing process. Primary cost, prime cost. So under prime cost, what do we have? Under prime cost, we have direct materials plus direct labor, and if there is any expenditure that happens to be an overhead that is directly attributable, direct overhead. Perhaps you hired a production room directly attributable to a particular what here production process that will fall under what we call direct what here, direct overhead. Great. Now, ladies and gentlemen, we come to the next concept here, which is very important. These overhead costs. Overhead costs, I would want you to understand what overhead costs are. Overhead costs that I would want you to understand is that overhead costs, as the name suggests, over the head. These are the common expenses. Common expenses that are normally incurred for the benefit of many units. They cover us all. Overhead costs, I'm repeating again, these are the common expenses, like rent. Rent is an overhead cost that we are incurring for the benefit of all the students of RCM College. Right? At the end of the day, we shall be seeing that these overheads, ladies and gentlemen, for pricing purposes, they must be apportioned to the units that are benefiting directly, so that we'll be able to establish what we call cost per unit. But most importantly, will be for you to understand something here. We said prime cost. Prime cost is material, labor, and any direct overhead. But generally, we have another terminology which is very important here called conversion cost. Conversion cost, the cost of converting raw materials into finished goods, are only two. It is labor plus what here? plus overheads. So labor plus overheads will give us what we call conversion cost. Because for you to convert, like now my timber, I will need a physical space, which I'm paying rent for. I will need workers to come and help me out to be able to carry out the conversion. So very importantly, for us to understand this from the word go, from the word go, from the word go, from the word go. So ladies and gentlemen, what you're saying in this case is that we can classify costs in accordance to what year, whether they are manufacturing or what year non-manufacturing, whether they are manufacturing or non-manufacturing. We want to put this clearly again in a way that all of us should be able to understand. Manufacturing costs are those costs, ladies and gentlemen, that are directly attributable to the units that we produce. And mostly, they are the direct labor and what year? The direct materials. And if you have been given, although rare, direct overheads will also constitute what we call manufacturing cost. Manufacturing costs. Ladies and gentlemen, outside the manufacturing cost, we shall be having now what we call the non-manufacturing costs, which are basically indirect. Non-manufacturing are what here are indirect. Non-manufacturing are indirect. Non-manufacturing are indirect costs. Indirect, why? They are not directly attributable to production. And in most cases, these manufacturing costs are the ones we call overheads. They're the ones we call overheads. They're the common expenses. Great. Now from there, ladies and gentlemen, we go to another classification, which now is the functional classification. Which is the functional classification. Under functional classification, ladies and gentlemen, we shall be classifying our costs in accordance to the various activities. In accordance to the various activities or functions that a company does. The major function, of course, will be production. We shall be having another function in the name of research and development. It's an activity which serious firms will always engage in, research and development. Ladies and gentlemen, we shall be having another function, for example, of distributing. So we'll be having distribution costs. We shall be having another important activity in this particular company called accounting/finance. So you're going to have finance or accounting costs. So for us to understand the functional classification, here we are sharing our materials. Here we are sharing our materials with you. So under functional classification, we are told these are those costs incurred to finance all activities that support production of goods and services. They include production, administration, selling, and distribution costs. So we have here like production, we have to produce as a key function. Production costs, these are costs incurred in the manufacturing process. They include labor, materials, and overheads as discussed above, direct overheads. Then we have administration. Administration is a key function of any serious entity. It's the sum of costs associated with the overall management of the enterprise, which cannot be readily identified with one of the major functional areas. A very good example of administration, ladies and gentlemen, will be the manager's salaries. We have selling. Selling is a serious function of any company. All those costs that are associated with the securing of orders from customers, these ones here must be included under selling. Costs like advertisement, like wages paid to salesmen, the commissions paid to salesmen. Then we have distribution costs, ladies and gentlemen. For instance, if you have a distribution van, the cost of storing these particular products which are finished, the cost of storing them for purpose of distributing them to the workers, automatically that will fall under distribution cost. That will fall under distribution cost. So, ladies and gentlemen, we have finance cost. Of course, you need to be accounting. You need to be accounting for whatever that you do in your company. So these are serious functionality. So these has to be categorized. You must have costs related to that, like the wages, the salaries of the accountants, etc., research and development. What you're supposed to understand, ladies and gentlemen, in short, is the fact that functional classification, ladies and gentlemen, entails what? Functional classification entails us classifying our costs in accordance to the activities we engage in as an organization. So it's very important for us to appreciate that. As an organization, which activities are we engaging in? Very important for us to appreciate that. So the various functions like manufacturing or production, research and development, finance, administration, selling, distribution, so various activities. I hope that is clear. Now we go to this other classification that we call behavioral classification according to cost behavior. How do these behave? Ladies and gentlemen, costs will be classified according to nature or behavior in relationship to change in levels of production, such as we have variable cost, fixed cost, semi-variable, and then we have the stepped fixed cost. The stepped fixed cost. Ladies and gentlemen, the most important thing that you're supposed to appreciate here in terms of behavioral classification is this, in terms of how they behave. Behavioral classification, how do they behave? You know, there are those costs that change as output changes. There are those costs in this case that are ever static, So in terms of behavioral classification, ladies and gentlemen, we have costs that are variable. We have costs that are permanently fixed. We have costs in this case here that are semi-variable. We have costs in this case here that are move forward in form of steps, what we call the stepped fixed cost. Ladies and gentlemen, variable cost, I would want you to appreciate from the word vary. These are those costs that change as the output changes, And normally they'll have a direct relationship. If this is output, then variable cost will behave like this. You can see as the output increases, variable costs are doing what? They are increasing. Variable costs are increasing. Great. So that is all about variable cost. Good examples of these variable costs will include things like raw materials, timber. The more the tables I produce, the more the timber I want. So timber cost becomes a variable cost. From there, ladies and gentlemen, we have the fixed cost. So fixed cost, ladies and gentlemen, as the name suggests, they behave in a funny way. For fixed cost, ladies and gentlemen, we'll always have our fixed cost being what here constant, regardless of the output. It doesn't matter how many units you produce. Fixed cost will always remain the same. For example, rent. It doesn't matter how many students we put in this room. Rent will always be what here will always be fixed. Now from there we have the semi-variable cost. Semi-variable cost, as the name suggests, ladies and gentlemen, this is how the semi-variable cost will behave like this. Semi-variable. So semi-variable costs are those costs that are partly fixed, and partly variable. Partly fixed and partly variable. So you can see it's not beginning from zero here. It's beginning from a point up there. Now listen. Ladies and gentlemen, listen. If you have, for example, an electricity bill today, if you give an electricity bill, trust you me that there is that component of your bill that does not depend on the number of units that you consume. There are those, ladies and gentlemen, Kenya shillings or whatever currency you're using, which will be put onto your bill that basically is dependent on periodicity, monthly, like Kenya shillings 120. Even if you close your house and go to Dubai for some holiday and stay there for a whole year, when you come back, you will never get your electricity bill being zero. You will get that 120 and the number of months that you are away, which is waiting for you. It's like a meter rent, a meter rent, a meter rent. Very important for us to appreciate that. That electricity cost can never start from, it starts from about 120. Now from there, we shall have now this component now of our bill, which is dependent on the number of units that we do what here, the number of units which we are consuming, Most importantly is for us to appreciate the fact that semi means half, partly fixed and partly what here, variable. And of course, the fact that under semi-variable cost, our cost will never begin from zero. Our cost will begin from some higher point up there and then move up like that, That's semi-variable. And then lastly, we have what we are calling the stepped fixed cost. The stepped fixed cost, as the name suggests here, stepped fixed cost, ladies and gentlemen, are those costs that look like staircases. They look like staircases like this. They look like staircases like that. So these are those costs here that will remain constant, for some range. They remain constant for some range, beyond which they increase in a lump sum manner, beyond which they increase with lump sums. For instance, we could have a very good example, a very good scenario with our landlord, where we tell our landlord that, ladies and gentlemen, for the first 10 students that we're going to have, we only need one room, small room like this, where you're going to be charging us, for example, 5,000 Kenya shillings. Meaning that for this range, I'll be constantly paying on a monthly basis 5,000 shillings. But now what if we get more than 10 students? Now, should we get more than 10 students, ladies and gentlemen, and perhaps go to 20, right? Of course, we are seeing a situation where now our rent will have to hike because we will want more space. So perhaps we could move from 5,000, depending on how big this other space we've taken, we could move from 5,000 and maybe to 15,000. But again, we are going to remain with this 15,000 for that range. Ladies and gentlemen, I would want you to understand this very well, that, ladies and gentlemen, that stepped fixed costs, they remain constant over some range, Beyond that range, they increase in a lump sum manner. In a lump sum, increasing lump sum means increasing with a one-off amount, And ladies and gentlemen, that now marks the end of what here? The behavioral classification. How do they behave in relation to what here? In relation to, now from there, ladies and gentlemen, we've got these particular ones, which are just a walkover that we need to explain very first. So we have classification according to controllability. Classification according to controllability, controllable will be having two classes there, two classes here. Under controllability, ladies and gentlemen, we shall be having two classes. Under controllability, we shall be having two classes. Which classes are these? Under controllability classification, we are going to be having those costs which are controllable, and those costs which are none or uncontrollable, as the name suggests. Controllable costs are those costs that we can control, that we can influence, their incurrence or not, as management. So as management within this firm, there are those expenses. If we say no to training, then our people will not be trained, will not incur training cost. So training cost becomes a very good example of a controllable cost. There are those costs, ladies and gentlemen, if we say we are going to squeeze them, reduce them, or even just make them zero, we don't incur them. If there are such costs, then such costs will be called what here? Controllable, because it is us to determine whether they will be incurred or not. Controllable costs. They are costs which are at the arm's length of the management. So it is the management that is going to decide whether they will be incurred or not incurred, or not incurred, or not incurred. All variable costs are controllable because we can influence the variable cost. We can influence them using what here? We can influence them using the activity, the output. We can say, let's produce little, let's produce less this year, and all those costs will go down like that. Uncontrollable costs, ladies and gentlemen, are those costs, ladies and gentlemen, that even if you decide to dance left as management or right as management, there is nothing you can ever do to them. Nothing whatsoever. Nothing whatsoever. Nothing whatsoever. Nothing whatsoever. So when we talk of uncontrollable costs like rent, you can't make a decision to reduce rent. That really is beyond you. There's nothing you can do about uncontrollable costs. Are those costs that you cannot influence. Whether you like it or not, they must be incurred. Whether you like it or not, they must be incurred. So long as you're within our premises, then rent you have to pay. So automatically, that becomes what here? Uncontrollable expenditure. Uncontrollable expenditure. Of course, you have our notes. You have our notes. Should you want more clarification on that, I'm so sure you'll be able to simply go down and check them out. Then we have a classification according to time. Under classification according to time, ladies and gentlemen, we have two classes. We have historical costs, those costs that have already been incurred. We call them sunk costs. Sunk costs. So for instance, when you are acquiring premises, you paid some deposit. That deposit was a long time ago, sunk into the landlord's account, right? Ladies and gentlemen, if you procured, for example, a van for ferrying children along from their homes, of course, to school, etc., the cost of that van is a historical cost. And as we shall be seeing later on, historical cost, of course, really, they don't influence our decision-making in the future. No. And then we have, ladies and gentlemen, what we call futuristic. The second class here is the futuristic, or predetermined cost. These are estimated costs that have been estimated for purposes of decision-making, costs that have not yet been incurred, which for purposes of creating a platform of effective decision-making process, we are trying to estimate them. We are trying to estimate them. So that is very, very important for you to understand. And then now we have classification based on identification with inventory. Identification with inventory. Under identification with inventory, we have got two classes. We have the product costs and the period costs. So under identification with the inventory, inventoriable costs, inventory, under classification with the inventory, we have what we call product costs. So product costs, and then number two, we have what we call the period or periodic costs, So product cost and inventory, these are those costs that are attributable direct to the manufacturing process. We can trace them and say, for sure, this component went to this particular inventory item, went to this particular good which was produced, like raw materials, direct labor, etc. So most importantly, product costs, these are those costs which are directly associated with the inventory items that we have. And then we have periodic costs. These are those costs that are uncontrollable. Ladies and gentlemen, these are those costs, whether you like it or not, they have to be incurred because they are time-based. For example, salary is paid on a monthly basis, rent paid on a monthly basis. They do not have any association, direct association to our inventory, So we have here classification for purposes of decision making, of which the first bucket here is the sunk costs that have already been incurred. In the future, they are not relevant to us. In the future, they are not relevant to us. And then B, we have marginal cost, is the additional cost of producing an extra unit of output. Marginal cost, the incremental cost of producing an extra unit. When you talk of marginal cost, when we talk of marginal cost, when we talk of marginal cost, ladies and gentlemen, if, for example, we have here 30 units, 30 units, 30 units, and then we have 31 units here. If these 30 units here were costing us 10,000, and the 31 units are costing us 12,000, then the incremental cost from 30 to 31, that incremental cost of 2,000 bob, which is 12,000 minus 10,000, this additional cost of 2,000 is what we are calling the marginal cost. Marginal cost is the incremental cost. By how much will our cost increase by? Should we increase our productivity just by 1 unit? Incremental cost is relevant for decision making. We shall be seeing this later. Incremental cost is relevant for decision making. Is relevant for decision making. Very important. Now from there we have opportunity cost. All opportunity costs, ladies and gentlemen, are relevant. Opportunity cost, ladies and gentlemen, basically are the costs incurred for the sacrifices that we make. For the sacrifices that we make. If, for example, for us to be able to produce a new product, we are going to sacrifice production of some existing commodity. The income of this particular commodity we are dropping is a sacrifice on our part. It's an opportunity cost. And opportunity costs for us are what here they are relevant for future decision making. They are what here they are relevant. Very important for us to pick this out. From there, ladies and gentlemen, we have the differential cost or incremental cost. These are costs that differ among alternatives. If you have got two alternatives, A, B, and then we go through our costs for A, costs over B. When we take the difference between the two alternatives are costs, of course, in this case here, we're going to have what we call, or rather we're going to experience an increase depending on what B is giving us. So that it becomes an incremental. All incremental costs, ladies and gentlemen, are what here? They are relevant. Remember, there is a difference between incremental and marginal. The difference is that marginal is only for 1 unit. Marginal is only for 1 unit. Marginal is only for 1 unit. And that is very important for us to do what here? To appreciate. And then we have the imputed cost. Imputed is another word for notional. Imputed cost is a word for what here? Is another word for notional. Imputed cost is a notional cost. And if it's a notional cost, ladies and gentlemen, a notional cost basically is an assumed cost. For instance, if as a RCM we own a building, right? If we own a building, it will be very important for us in our income statement to have rent. Where we'll be assuming, like, if we were paying rent, how much rent would we have paid? So then in our income statement, we shall be charging rent. Of course, that rent doesn't exist. It's an assumed one. It's a hypothetical one. So it is notional. It is what you're imputed. And of course, the essence of you imputing, the essence of you assuming some costs in your business is for purposes of creating provisions so that you don't go out there generating an income which seems to be so high, which you go ahead and share with your shareholders, disregarding the importance of the current status. Remember, you are consuming your property. So we should be creating a provision such that when this property will be run down 100%, wear and tear 100%, we'll be able, of course, to put up a better property, given that now we'll be having a depreciation charge for, and then an imputed. Very, very important. 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 And then, ladies and gentlemen, I would want you to appreciate here, another concept here is the replacement cost. I don't have to really talk about this in terms of decision making. Replacement cost, I'll be looking at a house, if it's a school, if I was to put it from scratch, start building it from scratch, then of course, whatever cost I'll be putting up, I'll be having, because that cost will be given to me by a quantity surveyor, a QS, then that will be the cost of replacing this particular building, So when we talk of replacement cost, replacement cost is the amount it would cost to replace an asset at current what-year prices. Then we have the standard cost. These are the normal cost. We are told the management tool used to estimate the overall cost of production, assuming normal operations, assuming that there will be no abnormalities, assuming that, for example, our world was to continue normally without corona effect. What would have we incurred to produce this and this? So, ladies and gentlemen, it will be very important for us to appreciate that a standard cost is a normal cost, which assumes what here normality of operations. From there, we have the budgeted cost. Its cost estimated to be incurred and used for budgeting purposes. It's a cost included in the budget representing cost expected, what we expect. Most of the times, budgeted cost will be derived from the standard cost. These standard costs normally help us to build the budgeted cost. Great. So, ladies and gentlemen, we have come to the end of this particular chapter. Of course, it can't go without me getting an opportunity of marketing our products. This is RCM. RCM, of course, is the #1 provider of great study materials in the name of textbooks, and what here? Revision kits, very, very affordable. And then, of course, we have these video classes. Should you be interested in our product, simply give us a call, not tomorrow, today. Give us a call today, and that is our great